Tobias Salinger, Chief Correspondent at Financial Planning. What's the latest on a major story you've been working on?
Well, last week we wrote about this case filed by Samantha and Kyle Busch against Pacific Life Insurance and one of the company's insurance agents over their indexed universal life insurance policies. They allege they lost over $8.5 million through promises of tax-free retirement income that never turned out to be true. And this case has moved into federal court. Just last week, there was an amended complaint filed by the Bushes. Pacific Life has denied the allegations. And there's a lot of court proceeding to come by to go right now. Actually, Pacific Life, I should be more precise. Pacific Life didn't comment specifically on the allegations, but they do say we stand by all of our life insurance products, including indexed universal life. An IUL policy provides valuable life insurance protection, helping ensure that families and other beneficiaries receive financial protection in the event of an unexpected or premature death of a loved one. So there's a long way to go for this court case, but why it's interesting for financial advisors and wealth management professionals is it really gets into what drew the Bushes to this particular product and why they say their agent and the insurance company acted with negligence, with a breach of fiduciary duty, with a violation of North Carolina laws about deceptive practices in business. And the main issue that they're talking about is this promise of retirement tax-free income, that they believed they would have access to up to $800,000 in tax-free income in about a dozen years through this indexed universal life insurance policy. So those are permanent policies that have adjustable premium and death benefits, but they're called indexed universal life insurance because they tie part of their cash value to stock and bond indices. So these are very complicated products. And of course, what financial advisors, wealth management companies out there will be taking from this is just how much review that they should take when they're considering a product like this. We all would love retirement income, especially tax-free retirement income. But the Bushes say that there was negligence on the part of the company and the agent in the way that they sold this product and in the way that they put together this product, to the point that they had paid over $10 million in premiums, yet they were told a few years ago that they needed to pay another premium. They thought that after paying $1 million a year for 5 years, that would be the end, and then they would have this retirement income. Kyle Busch is one of the most successful drivers in NASCAR, top 10 all time in NASCAR Cup victories, a two-time champ. And the idea was that by the time he turned 52, he's a mere 40 years old right now, but by the time he would be 52, they would have this tax-free income coming to them. And so you have to think about a promise like that. It sounds very good. I don't think anyone would say that sounds like a bad promise, but you have to dig deep into the policies, and there is a lot that goes into it. And now the Bushes are really crying foul publicly in addition to the lawsuit. They've posted a video with over 1 million views. And Samantha Busch called these policies that they were sold a major scam. Kyle Busch told people to run if they get approached with this indexed universal life insurance product. Experts in the field say it's a little bit more complicated, but there are some concerning practices. It reads a lot like a churning case. There was a 1035 exchange of these policies at one point, where they went from pretty much an identical policy to another identical policy, and there wasn't a big change other than the fees involved with that change. But they're also going deeper into the whole makeup of this product. So one of our friends in the insurance industry news publication world, Insurance Newsnet, asked if this case could be a day of reckoning for Index Universal Life in terms of the regulations that govern the sales of these products on a state by state basis. Or maybe this could just be an individual case where the Bushes are able to secure damages either from the agent or the company. So there's a long way to go, but I think it's a helpful cautionary tale for what the Bushes say happened to them. And I know that there are a lot of advisors out there who may or may not be selling this product specifically, but might have clients who bought it at one time and they're trying to unpack what to do. So this could provide another example of a time when some very well off clients feel that there was negligence by the insurance company and the agent who sold them these policies. So we'll be watching closely to watch how this case develops in North Carolina federal court.
Thanks, Tobias. It's a few things here to keep in mind, right? At the very least, financial advisors have to ask themselves, do I even want to be having these conversations with clients if I don't have to, given the fact that NASCAR is very popular, Bush is very popular, and there are other ways to manage a client's money. But then the alternative perspective is that the vast majority of people who have life insurance are not crying foul. So there's a lot to consider here. And then, of course, if you're looking at it from the perspective of an insurance company, a lot of this comes down to how the products are explained to potential life insurance customers. So lots of things to consider. Thanks for the deep dive here.
Thank you. Thanks for having me, Chris.